Below where we were. The good news on that, the IPO index has actually outperformed the S&P 500 by 20% over the last 2 years. So it's sort of like jumping into the deep end and saying the water's all clear, that you've seen some of these stocks do well coming right out of the gate.
Last point. Stephanie, you like the space?
I do. I think interest rates and the direction of them, potential direction of them, and the difference between 10s and 2s will continue to help them.
All right. Good weekend, everybody. Thanks for being here. Stephanie Guild, Cameron Dawson, Aya. We'll talk to you soon. Ayako Yoshioka joining us as well. All right, to Christina Partsinevelos now for a look at the biggest names moving into this Friday close. Christina.
Well, Scott, President Trump's rather not comments on tariffs sparking a rally for Chinese tech stocks. Shares of PDD, which is the parent of Temu and Pinduoduo, they are positive. You can see shares up 6%, and that's a positive spillover as well on JD.com and Alibaba, just on that softer rhetoric. NextEra Energy, the top S&P 500 stock, up about 6.5% right now, despite an earnings miss. And guess what saved the day? The CEO's promise to capitalize on the demand for AI and data center power. To do so, NextEra and GE Vernova will be joining forces to build natural gas power solutions. NextEra also looking to reopen a nuclear plant in Iowa. Scott.
Christina, thank you. Back to you soon. Christina Partsinevelos. We're just getting started here. Up next, star investor Benchmark's Bill Gurley standing by for an exclusive interview. We get his take on this week's big AI announcement, the drama between Elon Musk and Sam Altman, big earnings next week, all things tech with Mr. Gurley next. right, welcome back. AI taking center stage at the White House this week with the announcement of Stargate, a $500 billion joint venture between OpenAI, Oracle, and SoftBank. President Trump hailing the investment as a, quote, resounding declaration of confidence in America's potential. Only hours later, though, presidential pal Elon Musk publicly questioned the money behind the deal, which led to a back and forth between him and OpenAI's Sam Altman on X, just the latest incident in their ongoing beef. For more on what it all means and where this all goes from here, let's welcome in Bill Gurley. He is general partner at Benchmark. It's a CNBC exclusive. It's nice to see you again. It's been a while. We're really glad to have you today.
It has been a while. Good to see you, Scott.
You as well. So what is your view of Stargate?
Well, I've been trying to figure it out, and I think there's a chance that they may be too. It looked a little rushed on the announcement, and that would make sense, right? Because President Trump wanted to have some big wins early on, and so I think this thing got pulled together. I had a lot of questions. I actually posted those questions on X, and in the past 24 hours, I'll tell you what I think I've learned, but I've heard this from others. So I don't have access to the direct source. People are telling me it's going to be a propco-opco structure, which I didn't even know it was 24 hours ago. But it's like one person owns the property, the other one is the lease tenant of that property. They're potentially rolling in assets from Oracle that are in Abilene. There's a company called Crusoe that's been involved in the build of that. And OpenAI would be the sole customer, is what I've been being told. And I have three observations if all those things are true. One, I'm curious why SoftBank would want to be part of a private credit pool. It's not what they've typically done. I think it's clear from some of the back and forth with Microsoft that came out right around the same time that relationship, we knew there was tension. I think it's probably got more tension than even we thought before. And the third thing I would note is if it is a propco-opco structure, this represents a big lease liability or the equivalent of a lease liability for OpenAI. So this company already had probably the most complex cap structure of any company like it that we've ever known. And they're going to be putting one more complex piece on top.
It's interesting. I mean, when you use, the word like, suggesting it might have been rushed, are you suggesting that it's not necessarily what meets the eye, that you have some level of skepticism around this project, about the money, and whether it actually comes to fruition?
Well, I think a lot of people have voiced questions about that in the past 24 hours, and they certainly didn't release a bunch of details, so it's easy to be somewhat skeptical. I would also add there's been a lot of hyperbole in the AI market, and when you get Trump and Massa and Sam in a room together, I would expect some amount of over promotion. And, just because there's hyperbole doesn't mean these things aren't real. You can have prosperity and hyperbole at the same time. I think we have many times in the past. But yeah, there's a certain amount of promotion. We're trying to figure out the details. I think there's probably going to be debt involved, so it's not like they're out raising $500 billion in equity. And they're probably starting with a much smaller number and hoping to grow into that bigger number.
You also suggest, I think, that while many people are focused on Oracle, and the stock was up a tremendous amount, obviously, when the announcement came out, you seem to be more focused on the fallout, if you will, from Microsoft. And maybe there's more fracture between this relationship, and the fallout for it could be perhaps more dramatic that investors need to take note on. Is that correct?
One of the reasons I enjoy just digging and looking at this stuff so much is just how unbelievably interesting it is. I mean, this is better than a season of Succession, right? All these different players. You mentioned earlier the Elon Sam back and forth right after. We've never seen this kind of thing before. The deal between Microsoft and OpenAI, as it's been reported, once again, I've never seen it. Sounds like one of the more complex deals of all time. They have profit rights up to $90 billion. No one's ever signed a piece of paper like that before. And so we don't know, it sounds like OpenAI wants them to convert to equity, and we have no idea whether they're willing to do that or not. And I think all of the things that happen on the field, whether it's Sam talking about AGI's coming and now he's backing off of that, or this announcement, I think they're all chess moves in a much bigger game in terms of them trying to figure out that relationship.
This beef between Altman and Musk, I'm assuming you know both personalities reasonably well. Are you all just sitting out there with popcorn in hand, wondering what's going on and where this is all going?
I mean, like I said, it's better than an episode of Succession. I think it's super interesting and nothing we've ever seen before. And we've moved to this world where these types of executives have this active voice on X, which gives us, this kind of real time view into it. But it's ultra interesting. Obviously, they've had a much closer relationship than I've ever had with either one of them, right? And that obviously is frayed.
But I mean, it seems to be at least partly centered on OpenAI's ambition to morph from a not-for-profit into a for-profit entity. Obviously,
Absolutely.
Elon has competing interests with his own XAI.
Yeah, those came after that beef was kind of uncovered, right? And you can imagine, like you've done well in life, you decide you want to start giving back, you help prop up a nonprofit to solve some type of world problem that you think needs to be out there, and then you turn your back, and next thing you know, people are putting billions of dollars in their pocket. I could see how that might upset somebody.
Are you an investor in either Open or X?
No, I am not.
AI?
I am not.
Neither.
I am not.
Did you have the opportunity to and just passed?
I did not.
Okay. You've been thinking a lot about AI regulation and what's known as regulatory capture. Now, we don't talk about it all that often, that specific, verbiage, if you will. But you did say at an event some 18 months ago, and I want to quote and get your reaction to this. You said there's a really scary thing in this AI space. The incumbents that are running to meet with the governments are spreading something that I don't think is accurate or fair. They're spreading a negative open source message, and I think it's precisely because they know it's their biggest threat. Now, Sam Altman has obviously said there needs to be more regulation. Are you suggesting that he thinks that and is arguing that because it will help him and OpenAI and hurt whatever startup competitors might be there either now or in the future?
Yeah, I do believe that's the underlying motivation. And there's Politico articles that show only since SBF has any startup put together this amount of a kind of force in Washington, D.C. to try and get their policy written. And people that are investors in that company and Anthropic as well have been beating the drums trying to get regulation passed. They helped push through the Biden executive order, and they're still pushing. They're pushing in like 25 different states. We now have a whole bunch of states threatening to do what California tried to do before Newsom vetoed it. And so the good news is, from an open source standpoint, I think enough people spoke up, and not just me, many other people, to push back. And I think there was a wonderful piece that I'd like to link to that Deidre Bosa just did on DeepSeek. But like the open source performance is right there now, and I don't think you can put the cat back in the bag.
Who do you think is going to win this whole arms race? If there needs to be, one winner, but if we're going to give a gold medal and you're going to have a medal stand, who do you think stands to be the best? Is it OpenAI? Is it what Google's doing? Gemini, Meta, Llama, Perplexity? How do you see it?
I mean, I think certainly to date it's been OpenAI, and keep in mind, these companies are doing something that's also unprecedented on the liquidity side. They're giving employees that are 2 years in secondary stock. So they're winning already. They're putting cash in their pockets, right? And so in some ways, they've already won from that standpoint. If you look back at the internet, something really interesting happened. You had, at the beginning of the internet, you had every startup developing on Sun and Oracle. It was the highest performance. You weren't worried about cost optimization. You were worried about being first to market. And you went out and rushed out and bought the best that you possibly could. We may be, and I think Deidre also did a great piece on whether or not we're hitting scaling limits. We may be moving from performance at all costs to the optimization phase of AI. And we will at some point in the future, even if it's not today. And that may mean that there are different companies that are doing different things. It could be positive for open source. It could be positive for these inference clouds that are working on super high performance inference. It could be positive for non-GPU startups like Grok or Cerebras, or even Google's TPU or Amazon's Trainium. All those things could be better positioned in an optimization phase than maybe they were in the build-out phase.
I'd love to get your view on just, I guess, what you can call this remarkable transformation of Silicon Valley and its major players, at least from a political standpoint. You saw the pictures like everybody else did of who had the best seats in the room for the inauguration. And maybe we can show that if we have it. There it is on your screen. You know, a lot of heavyweights, obviously. And then you have, you know, Mark Andreessen, David Sachs, Elon Musk. They're all now in the room where it happens. I'm curious your view, because you did say at the same talk I referenced earlier, quote, the reason Silicon Valley has been so successful is because it's so effing far away from Washington, D.C. Well, not so much anymore. And the cynics in the room might say, I mean, Silicon Valley doesn't want Washington anywhere near it unless it can be directly helpful to it. How would you respond?
I would agree with that cynicism. Like my talk was about the startup world and, you know, early stage startups and the problems that regulation could cause in that formation stage. Clearly, big tech has arrived in Washington, and that may actually be bad for startups, right? If they may start to do the type of regulatory capture that has happened in finance and telecom and all these other industries, pharma in America, and so it actually could be bad for early stage startups. I think it's good for a few things. It's obviously good for crypto. There had to be some weight on crypto stocks that had to do with regulatory risk, and I don't think they could have imagined a better outcome than they just got in the past 48 hours. It could be good for M&A. M&A's been really quiet, and people anticipate that door will open. I don't know if it'll be good for IPOs. There's something broken with the IPO market, and I have no idea if Paul Atkins is aware of that or wants to fix it.
In terms of what's broken, I mean, I understand that, you know, more companies want to stay private for longer. They don't need the access to capital, I suppose, so desperately as they once did. There's just other sources for it. We just had the largest IPO, I said, down here at the New York Stock Exchange today since July. But what needs to be fixed if it is in fact broken?
Well, I was going to say, if you look at the IPO count, this may be dollars. If you look at the IPO count, we're way off of any trend line that's ever happened. I would say another thing, which is we used to always talk about the IPO window being open, and it was heavily correlated with the performance of the markets. Well, here, the markets have been performing just fine, so there's no reason to suggest that the problem with the IPO market is due to the performance of the market itself. So I don't think the window is closed for that reason. It may be because of what you talked about, and I think that's certainly part of the problem. I personally, and I've been on this for a long time, think that the lack of efficiency in how the IPO market works is a huge part of the problem. If you're going to underprice every IPO by 30% and there's a super active liquid private market, you're just going to get outbid. There's going to be no reason to go to public market because it's more expensive than the private market.
You know, I remember, I mean, you and Brad Gerstner and I went deep on that on one of my visits out to the Bay Area. So your points are well heard. It leads me to, you know, Brad, when I was last out there, revealed that he had sold Uber, in which you were an early investor, obviously. And one of the reasons he did that was because he now thinks that Tesla has such a huge advantage in full self-driving. I'm curious as to how you view those two stocks, specifically Uber, whether you're still an investor in that name, whether you would be, and just how you view it overall based on what, you know, your now podcasting partner, Brad Gerstner, told me the last time I was out there.
Yeah, I am still a shareholder, and I'm been super both appreciative and impressed with what Dara has done in the CEO role. It's clear that one of the questions about the stock is now tied to self-driving. I would offer a few points to think about. One, the overall market is still growing. I think the move that it takes for people to move from car ownership from 3 cars to 2 to 1 is a very slow process. And the awareness of Uber and it just keeps unlocking. I think this is a market that's going to see 10, 15% growth for 10, 15 more years because we've been so obsessed with car ownership, and now people can start to think about what it means to not have it. The other thing about autonomy is if you're going to build a fleet, I always say this, you're going to build to peak or average. And both of them are bad answers. If you build to peak, most of your cars are sitting around, so your utilization rate drops to the floor. If you build to average, you're never available exactly when people need you the most. And so I don't think autonomous alone works. Obviously, one of the approaches that Uber is taking is partnering with all the different autonomous makers. I personally think the right move, and this was, I think, the right move many years ago, but still today, would have been for Uber to help lead an open source movement here to help commoditize the autonomous car. We've watched Meta do that in AI extremely well, just here in the past 4 years. And I think that's the better playbook. They're not operating that right now.
I'd like to ask you one more question, and I'm not sure if you're an investor or were in ByteDance or not, but how do you think this whole TikTok saga ends?
Well, my own interpretation of what went down recently is the following. President Trump is notorious for being a deal maker, right? And he saw an asset that was about to evaporate, and if it evaporates, I'd say most of the value goes to Meta, maybe a little to Snap, right? Like that's where all those people are going to move. And so it's like, oh, wait, there's an asset. Let's not let it go away. Let's see if we can trade it for something. I've never heard of putting equity on the U.S. balance sheet. I'm open to how that might play out. I think when we bailed out Goldman and United, like that's what we should have done then. I think we have done it in the past with banks, but we'll see. I think based on my interpretation of law, he's really only got 90 days. And the company had plenty of days before that to do the exact kind of thing they would need to do now to get around the law. So I don't know what's new other than he's going to stir up a lot of debate and conversations.
To say the least. I've liked our conversation very much. It's good to have you back, Bill. Take care. We'll talk to you soon.
Great to see you. Take care.
You as well. That's Bill Gurley of Benchmark. Up next, Bank of America's Jill Carey Hall is revealing her outlook for the small caps 2025 after this break. It's all for AI. We're back. S&P 500 hitting a record high earlier today before turning lower. Meantime, the Russell 2000 still well off its own November peak. Here to share her own outlook for the small cap space is B of A Global Research Head of U.S. Small and Mid Cap Strategy, Jill Carey-Hall. It's good to see you again.
Thanks for having me.
All right. A lot of people think this might be your moment. I don't know. You tell me.
Well, I think this is going to be a year where you want to own mid caps over small. I think it's still a tough backdrop for the Russell 2000, and the profits growth recovery story that a lot of investors were bullish on last year. That's just continued to get revised down, pushed out further into 2025. So small cap profits have continued to disappoint. And, you've still seen negative year-over-year earnings growth in that size segment. The fundamentals have been better in mid caps. So if we do see a market that broadens out, we think mid caps are actually the size segment that could offer the best risk reward, especially if you're now in an environment where multiple rate cuts have gotten priced out of the market. Our economists at B of A are expecting the Fed stays on hold from here and doesn't cut any further. So small caps obviously have a lot of refinancing risk, and that risk has sort of reemerged as the rate risks have gone up. So mid caps have better balance sheets, better fundamental trends. So that's where we would position, within small and mid.
So it still matter. Rates still matter more than anything else, because I was going to say, with all the optimism around the economy going forward and policies from Trump 2.0, if not now, when? We've been waiting and waiting and waiting for some sort of sustainability from this space. Sure, we've seen great moves, but they've been short-lived.
Right. I mean, I think, after we've seen this decade of underperformance for small caps, historically speaking, we're due for an outperformance cycle. And that's what relative valuations would suggest. So I do think if you have a longer time horizon, over the next decade, which is when valuations tend to be the most predictive, that small caps could offer the best price returns of the size segments over the next decade. But, this year, I think there's sort of, after all the underperformance, it's a high bar for investors. They're sort of nervous about jumping back into small caps. I think there's definitely optimism there, optimism around the economy, optimism if we see deregulation. But the profit story, I think we'd like to see a more convincing turn. And rates stabilizing, or perhaps if cuts get put back on the table, those would be beneficial for small caps. The Fed and expectations have been one of the biggest drivers of the rallies and the sell-offs that we've seen in the Russell over the past year. December was the worst relative month for small caps versus large that we had seen in over 25 years, and a lot of that was right after the more hawkish Fed meeting. So I do think there's a lot of opportunities still within domestic mid caps, and so I really think this is a year where you want to be selective, and it's going to pay to be selective rather than just owning a benchmark. If you can own smaller mid caps that have profits, less leverage, less refinancing risk, or economically sensitive, I think those are well positioned. I think pockets of the market are certainly going to benefit from the backdrop that we're seeing if there is deregulation, if there is an M&A pickup. So financials look well positioned in our work, and just simply owning stocks that are seeing estimates go up rather than down has been one of the best factors within small and mid caps recently.
We'll talk to you soon. Jill, thank you very much for your time.
Thank you.
Up next, the biggest movers into the close. Christina is back with that. Tell us what you see.
Love's algorithm paying off as one dating app sees its shares double in a year, and chip makers hit a bumpy road. Details after this short break.
guarantee.
We're about 10 from the bell. Back to Christina now for the stocks that she's watching. Hi there.
Grinder, hi, by the way. Grinder's on fire, up over 6.5% today, with shares more than doubling just in the last year. The company's full-year revenue target getting a bump thanks to growing subscriptions and ad revenue. It's also smoothing out its warrant structure, which could ease investor concerns about potential share dilution. And it's actually up almost 8%, I should say. Texas Instruments CEO warning on the earnings call last night that they, quote, haven't seen the bottom yet in core auto and industrial chip markets. Other issues weighing on the semiconductor maker, gross margin pressures, lower Q1 earnings per share guide, and increasing inventory shares down 7%. Scott?
All right, thank you very much. That's Christina Partsinevelos. Still ahead, Novo Nordisk shares are jumping today. We'll explain why in the Market Zone next.
Ready AI.
All right, coming up next, Novo shares jumping on some critical obesity drug data. The details inside the Market Zone next. We're in the market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of the trading day. Angelica Peebles on a major win for Novo. That's where we'll start. Give us these details, if you would, Angelica, and why Novo shares are on the move.
Yeah, Scott. So today, Novo sharing some promising early data for one of its next-generation obesity drugs. That drug, amycretin, helping people lose up to 22% of their body weight, and that puts it on par with Lilly's Zepbound, and the total could go even higher as Novo continues to study this drug over a longer period of time. Now, there are some caveats. This is an early-stage phase 1/2 study, and so there was only 125 people in here, and Novo at this point is not telling us too much about the side effects, just saying that it's in line with what we've seen with other GLP-1s. But that's a key question going forward for all these next-generation obesity drugs. And, of course, so this is a much-needed win for Novo after what's been a pretty rough few months. They've had some setbacks and disappointments in their pipeline, and that stock has not done too well. So now this is a much-needed win for them. Scott?
All right. And, yep, Angelica, thank you very much. Angelica Peebles with the latest on Novo shares today. Mike Santoli sitting next to me. We'll go into the weekend here. Are you feeling pretty good about where we are overall?
Generally good about how the market responded over the last 2 weeks to what was really kind of an internal washout. And so we got oversold, sentiment got a little bit concerned, and we managed to capitalize on that. So to me, that's the first test. As yields come in, can the market actually find its footing and get back to the highs? It did. In fact, in the last few minutes here, we're also kind of perking up a little bit toward that 6,100 level. Second day after a new high, you don't want it to fall below the old high. That was 69. So all to the good. I don't think it was the most assertive, high momentum buying binge. It was much more about, hey, we're getting back on trend, and that makes a lot of sense. Tactically speaking, there's a bunch of little short-term gaps underneath this market just on a technical basis because this move higher in the last 10 days has been kind of jerky. So 60.50, 59.50 wouldn't be that shocking to back up. Today is also really about NVIDIA. You had more stocks up than down today, and NVIDIA is having a little bit of a rethink on the AI hardware story.
I mean, we have to brace. Let's not forget, look, we're only a handful of days into the second Trump administration. Don't know exactly the schedule of when things are going to come down. We're still presumably waiting on tariffs. Maybe we need to react to some things next week. On top of that, you have the mega cap earnings, so it could be full next week.
And I do think that's the direction of risk when it comes to policy influence. We're priced for a pretty good scenario right now. We're priced for no immediate punitive tariffs. I think if the market goes searching for something to get concerned about or have an excuse to back off a little bit, it's not going to be hard to find it when when we're talking about trying to get Greenland and kind of having a lot of these kind of rapid fire and sort of erratic policy moves. Now, most of it's not that relevant to the business outlook or the tax structure or anything like that, so it's fine. But I do think that you have to be aware that we do have that influence that could, in fact, create an excuse for volatility that we've just not seen the last couple of weeks.
Got to watch the dollar, which is getting a little bit of a break today, but it's been a big story as well. So has crude oil. President talking
dollar is definitely a tariff trade as well as, of course, a Fed trade, which we're going to get next week as well.
Yeah, and we don't really expect anything, but you never know. I mean, the commentary is more valuable than the move in this case.
Good weekend.
Good weekend to you, Mike. And certainly all of you as the bell rings. We'll go out red. I'll see you on the other side into overtime with Morgan and John.
Well, that bell marks the end of regulation for the week. New York cares, ringing the closing bell at the New York Stock Exchange. TSS doing the honors at the NASDAQ, and stocks taking a pause from their climb to record highs, but still going out with solid gains for the week. That's the scorecard on Wall Street, but we're going to stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan.
Well, the tech sector wrapping up a strong week, but the action really heats up next week when Tesla, Microsoft, Meta, and Apple all report earnings results. We're going to talk to investor Dan Niles about his expectations ahead of those key prints.
And it's the IPO market back. It was a big day for public listings as Venture Global made its debut, but it wasn't the only one. We'll talk to the CEO of Ascentage Pharma, the first biotech IPO of 2025. First, though, let's get to the market action with Unlimited CEO Bob Elliott and Interactive Brokers Chief Strategist Steve Sosnick. Guys, happy Friday. Steve, we've got a quiet VIX to end the week, the volatility index there. Big earnings week coming up, though. So how should investors position?
Well, hi, John. Thanks for having me. I think this is a time to always remember that buy low, sell high doesn't only work in stocks; it works in other products, and sometimes it works. It often works in volatility, which tends to have more of a mean reverting basis than stocks do. And so, when you see going into a week that promises to have a huge array of earnings, just think of Wednesday itself, which has an FOMC meeting, Tesla, Meta, and Microsoft, basically, I think are the ones coming out that afternoon. And yet you see VIX with a 14 handle and the VIX 9D, which is the 9-day version of the VIX with like a 12 handle. That's telling us that investors are not pricing in very much volatility for the coming week or for the coming 30 days. And to be fair, I think that's a little bit much because I do think that there's certainly any number of things. There's always any number of things that can cause volatility. But this one, we have a lot of what I would call known unknowns coming down the pipe in a very short period of time.
Okay. Bob, so keeping it on big picture strategy here, here's what BlackRock CEO Larry Fink said about bonds and inflation from Davos earlier. Take a listen.
I think the bond market is the best reflection of what's going on in the world. It is the barometer for every politician, for every central bank. It really informs us every day where the mood of the global economy. And that I believe the bond market is indicating that inflation may be higher than we think.
Sounds familiar. Well, what's the bond market whispering in your ear? What should investors do about it?
Well, I think the bond market, particularly when you look at the real yields, still at basically all-time highs of this cycle, suggests pricing in a pretty strong economy ahead. And that's basically what you see across all markets, which is whether you're looking at stocks and earnings expectations, valuations, what's being priced into the real interest rate market, or what's going on in credit spreads. Every single market is basically pricing outcome ahead, very different than what we saw, say, to kick off 23 or 24, when there was a lot more reticence about what was going on with the real economy.
And it's interesting, too, because, Bob, I mean, we did see, I think, a pretty weak day, or not just weekday, week for the dollar index. That really came off, given the fact that we didn't see those tariff and trade realizations, at least not yet, in the first couple of days from President Trump. But we were talking about this yesterday, and I want to put it in front of you, since I know you closely follow institutional flows and what the hedge funds are up to and their positioning as well. And that is the fact that you have a week where stocks are ending higher. We've seen a reversal, and stocks are now higher to start the year. And yet we haven't seen those institutional inflows yet in this rebound either. What does it take for that to happen?
Well, I think a lot of those institutional investors are recognizing the uncertainty that sits in the market, and that given, in particular, the policy uncertainty, we thought we might get some clarity to kick off the week, and yet we end the week with some rhetoric at some press conferences, but nothing real about what tariff policy is going to look like ahead. Given that this is the time to not have particularly strong conviction across markets, I think that's interesting in the context of how they're priced, which is when you then look at what's going on with earnings expectations, or look at what's going on with the stock prices making new highs. Essentially, the market is saying we're free and clear, life's going to be great, we're not so worried about any of these possible policies. The institutional investors are saying maybe not so fast, we should be a little more cautious given how much uncertainty there is.
Steve, I want to get your thoughts on this, because we've been having a lot of debates about valuation here as well. You just talked about uncertainty as we go into next week, whether it's earnings, whether it's the Fed, some of the other big, more macro possible catalysts for this market too. We might not see the institutional inflows, but we are seeing retail investors participate in this market. You can even argue there's some frothy parts to this market right now too.
Yeah, I mean, our customer base is not purely retail. It covers the gamut from small retail to large institutions. And I would say a lot of it probably falls under the category of pro-tail, people who are individuals but trade very actively. They are very much still in a buy mode and a buy mentality. There's a lot of trend following. There's a lot of momentum playing. They're very quick to jump on any names that are very hot. It's been working for them, and it's not. I don't want to dissuade anybody from doing what's working, but a lot of this energy is coming from smaller investors. And to the point of the question you asked, Bob, I've seen that some of the numbers of cash levels at institutions are near record lows, so they don't necessarily have the ammunition to move into the market. The public, though, is doing it to some extent for them. And of course, if the public moves into larger vehicles, well, then the institutions get the money from the public. But but our customers have definitely been looking for opportunities to buy dips, buy rallies, etc.
All right, gentlemen, thanks for kicking off the hour with us. Steve Sosnick, Bob Elliott, wonderful to have you. A down day fractionally for the major averages, but all the major averages finishing the week higher, and the S&P, it looks like, finishing just above that 6,100 level, 6,101. Well, with the S&P 500 hitting all-time highs earlier today, Mike Santoli is digging into how the U.S. is faring versus the rest of the world. Mike.
Yeah, it's been a pretty lopsided game, U.S. Versus the world, for a while now, and the fund flows really mimic that. So the money is chasing the performance, and this is the U.S. cumulative net inflows into U.S. funds relative to rest of world funds. Or it's going back to 2020. Obviously, we had a very steep ascent here, money chasing our growth-driven markets over here. Now, the big question, of course, is whether people are leaning too heavily in that direction, if you should bet at all on mean reversion at a time when consensus is U.S. exceptionalism on an economic fundamental basis and otherwise at this point. By the way, the U.S. market cap is like 2/3 of world market cap right now. It's pretty remarkable how dominant it has become. Now, take a look at the index performance over the last couple of years. The S&P 500 relative to, this is the Euro Stoxx 600, and that's ACWX's all stock markets outside of the U.S. So you see the massive gap that's opened up. I do think it's interesting, though. Euro Stoxx has broken finally to a new high. It's on a nice little run. It's not just the luxury stocks. It's also things like European banks. So maybe at a time when there's very low expectations for the European economy, the euro obviously has been weaker. You have a easing bias from the ECB. People are starting to say maybe things can look up from a very weak starting point at this level. Also, we'll mention a lot of folks who want to say that there's going to be a rotation in the U.S. market towards cyclicals or value or smaller stocks. Those types of dynamics, if they were to happen, would also imply that the rest of the world type of stocks, which match up with that profile, might do better as well, Morgan.
I mean, we did just talk about the fact that the dollar index had its worst week since November of 2023.
Yeah.
But we also know how strong it's been to get to this point as well. I want to go back to something you just said, and that is about this de-easing bias in Europe, because not only do we get an FOMC decision next week, but we also get Bank of Canada, and we do get ECB. And ECB is expected to not be on hold the way the Fed is.
No, that's exactly right. So it'll be interesting if we get anything in the way of color from Jay Powell at the press conference next week that suggests maybe, let's say, a March rate cut looks like it's on the table for whatever reason, if the committee has come around to that idea. If we do start to see those differentials narrow a little bit, that might also help restrain the value of the dollar. Of course, Bank of Japan hiking, always go in the other direction. So you have this dissonance in central bank policy that's whipping the currencies around. But yes, I do think the hawkish turn by the Fed contributed, among a lot of other factors, to the fact that the dollar had that great run.
Mike Santoli, see you again in just a bit. Well, after the break, we are getting you set for perhaps the biggest week of earnings season as Tesla, Microsoft, Meta, and Apple all get ready to report results in the next 4 trading sessions. Investor Dan Niles is going to join us with his playbook for that massive week ahead.
And American Express dragging on the Dow after earnings this morning, but the company's CFO telling CNBC that one key consumer cohort is showing strength, and it could be a good sign for the whole economy. We've got that story and so much more all straight ahead on Overtime.
Welcome back to Overtime. Big Tech takes center stage next week as the Magnificent Seven begin to report. Tesla, Microsoft, Meta kick things off on Wednesday, followed by Apple on Thursday. The Mag 7 as a whole up nearly 18% since the election, outperforming the rest of Big Tech. So will earnings provide another boost? Let's bring in Dan Niles, Niles Investment Management founder, portfolio manager. Not a big Mag 7 fan from an equities perspective right now, but Dan, is next week the week when the results, the numbers start to have people doubting the stock's momentum?
Well, I think it's going to be the reaction to the results. I always say it's not the data, it's how do you react to it, right? Because you can look at 2021, inflation went from 1%, 1.4% to 7% to the end of the year, and the market was up 27%. And then obviously 2022, the S&P was down 19% as inflation peaked and started to come down. So it's never the results, it's how you react to them. And next week you have a couple of very well publicized things that are going to happen. Everybody on the planet is expecting Apple to cut their numbers, which I think will happen. And so then the question is going to be, how do investors react to that? Because the bulls for the last 3 years have been, well, there's an upgrade cycle coming. And so the multiples just kept expanding while numbers have come down. And so the question with Apple is, at a 29 PE, with the S&P sitting at 22 times, do people sign up for a fourth year of trying to pretend an upgrade cycle is coming or not? And then likewise, on the other side of the spectrum, you've got the high expectation names like Meta, which I think actually deserve it. And we'll have to see how people react to a lot of the advertising-driven models, because you don't have an election in Q1. You don't have the in 2025. Easter is shifting from the first quarter on March 31st, which is what happened in 2024, to April 20th. So you're not going to have the spend associated with that. And then finally, covering all of these companies, is the dollar went from 101 at the end of Q3 to ending the year at 109. And then you had Netflix set at a really high bar, just blowing out numbers.
Yeah, so, speaking of reactions there, the reaction to Netflix was pretty positive. Some might argue in the guidance, despite the strong dollar. Of course, they had those strong membership numbers at the same time. Is what you're saying that Apple might provide a little bit more nuance into how investors are looking at that guide, if indeed their numbers are not as enthusiastic?
Yeah, and I think the reaction, because Apple comes on Thursday, the other three come on Wednesday, and so I think that gives you a hint if you're going to want to trade around it. From a longer term perspective, Meta is using AI the best, and you're seeing that in the performance this year, where it's up 11%. And you had numbers go up all last year, despite them taking up CapEx all last year. Apple, likewise, is using AI the worst, or has really no AI presence. Their stock's down 11% to start this year. And they were the second worst performing of the Mag 7 last year. So to some extent, the market's starting to differentiate between all of these names. And I think from a longer term perspective, Meta's a longer term winner. Amazon's a longer term winner. I think Microsoft actually, given their fraying relationship with OpenAI, and don't forget, Microsoft guided below the street when they reported in June for September. They guided below the street when they reported in September for December. And I honestly think Azure, some of the positive comments they said about reacceleration, I think they may temper that a little bit. And so I'm a little bit more concerned about Microsoft. And so that's how I would, and then you have Tesla obviously in its own little world because of the relationship of Elon Musk with Donald Trump. But, and so that's not a name, being a growth at a reasonable price investor that I am, that I'm really looking at. Right now, though we did buy, we were focused on that after the election.
Yeah.
We'll see. So each one is different. I don't think you can trade them as one big group like you could last year or the year before that.
In light of that, Meta did say, Zuckerberg actually today said that Meta's going to spend up to $65 billion on AI this year. That's a 50% increase over last year. So these CapEx numbers we do get from these hyperscalers next week, how much are they going to matter to this AI ecosystem at a time where, look no further than Stargate earlier this week, investors are back in that AI trade and certainly going to be wondering what continues to fuel NVIDIA from here?
Well, you bring up a great point, Morgan. So Mark Zuckerberg came out, said 60 to 65 billion. What did NVIDIA stock do today? it got hit. So it tells you that investors are thinking beyond this to other things like DeepSeek, and did they in fact trade a model for $6 million? And so if you're cutting your training cost by 1/10 because you're doing things with the algorithm that really help cut down on those training costs, then do you need to spend $100 billion for Stargate or $500 billion ultimately? Can you cut back on that? And then does the value really start to show up at the agent level where software sitting on top of these massive hardware models? That's where the value accrues. Like if we can get on and say, book me a hotel in San Francisco for $500 between these days and get me an air flight, and an agent does that all for you and it does it well, then that changes where the value is going to start to accrue, because ultimately I think you end up with the hardware layer getting commoditized and the value accruing to the software layer or agents or however you want to think about it. And I think the hardware training costs continue to drop. And so what you see outperform is going to drastically change. And as you know, I've been saying for a while that we're going to run into an AI digestion phase sometime by the middle of the year. And I think the DeepSeek stuff that came out on Christmas Day actually probably adds to the potential of that happening.
Yeah. If we're moving into that phase of AI deployment, the application and adoption phase, that could potentially be very deflationary more broadly for the economy. So how do you game that out as we do look to a Fed that's expected to be on hold next week, and all of this talk, we just highlighted it with Larry Fink earlier in the show, about the possibility of inflation being higher than is showing up or stickier than has been expected previously to be?
I think you asked the most relevant question, Morgan, because it really does come down to inflation. And as I said earlier, it depends on how people, whether they acknowledge it or not. People didn't acknowledge inflation in 2021, even though it went from 1.4 to 7% for CPI, and the market went up 27%. Next year, they acknowledged it, market went down 19. And if you look at the inflation metrics this last year, headline PCE bottomed in June. It had been going up since then. All the other inflation metrics for PCE and CPI bottomed in the third quarter and been going up, and the market just didn't care, much like in 2021. Then the Fed came out on December 18th and said our inflation forecast had, quote, kind of fallen apart. The S&P went down 3% that day, and I think that may have rung the bell, much like when the Fed said it wasn't transitory anymore in 2022. And you're right, the AI stuff is deflationary, but don't forget the pro-growth policies of President Trump are inflationary. And so it's going to be, how do those two things work against each other? And I think some of that hinges on whether the Department of Government Efficiency can actually get government spending down, which will also help offset some of the pro-growth policies that are in place. And so that's why I think this year it's going to be paying attention to the data and then reacting to it, versus having some long-term forecasts, because I think every data point that shows up, much like it mattered at the end of 2021 going into 2022, is really going to matter. And then stock picking underneath it is going to make a big difference, which is why this year our top 5 picks, they're more focused on networking type companies or banking companies that benefit from deregulation and tax cuts versus going after the Mag 7 again, or the banking companies, which we like, where they benefit from tax cuts and deregulation. And four of our 5 picks, cash being the other one, are doing better than the market already to start this year, even though they're quote unquote not that sexy.
All righty. Well, Dan Niles, thank you for joining us.
My pleasure.
After the break, is a thawing of tensions with China on the horizon? Well, here's what President Trump told Davos yesterday.
I like President Xi very much. I've always liked him. We always had a very good relationship.
We'll talk about what tighter economic ties between the U.S. and China would mean for investors, or maybe status quo.
And the CEO of Ascentage Pharma will join us on the company's first day of trading as the IPO market shows new signs of life. We'll be right back.